Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sandisk Corporation quarterly report. Sandisk Corporation offers a wide range of data storage devices and solutions using NAND flash technology. The company's product portfolio includes solid-state drives for various applications such as desktop and notebook PCs, gaming consoles, and set-top boxes. Additionally, Sandisk provides flash-based embedded storage products for mobile phones, tablets, and other portable and wearable devices. The company also offers removable cards, universal serial bus drives, wafers, and components for various industries including automotive, Internet of Things, industrial, and connected home applications. Its customers include computer manufacturers, original equipment manufacturers, data centers, private cloud customers, cloud service providers, resellers, distributors, and retailers. Sandisk Corp has experienced an extraordinary surge in its stock price over the past year, with some investors seeing a staggering 1,747.89% return on investment since the company's IPO in 2025. This remarkable increase can be attributed to several key news events that have contributed to the company's financial success. One of the primary drivers of Sandisk's stock surge is its exceptional earnings and forecasts. The company reported blowout earnings for its fiscal second quarter of 2026, leading to a highly optimistic earnings forecast that helped justify a significant stock increase. In fact, December quarter earnings doubled FactSet consensus estimates, while March quarter earnings guidance more than tripled the consensus. In addition to strong financial results, Sandisk's data center revenue has seen a substantial sequential increase of 64%, reaching $440 million. This growth is accelerating the company's shift towards a more diversified business model. Furthermore, analyst upgrades have also played a significant role in driving up the stock price, with one upgrade described as one of the most delayed upgrades in history. The extension of Sandisk's joint venture agreement with Kioxia through 2034 has also contributed to the company's stability and strategic partnership. This move has provided investors with confidence in the company's long-term prospects. Overall, these events collectively demonstrate robust financial performance, positive outlooks from the company and analysts, and strategic business developments that have fueled the substantial increase in Sandisk Corp's stock price over the last year. Sandisk Corporation market capitalization of $101 billion is significantly larger than the average industry peer of roughly $15 billion. This shows that Sandisk Corporation holds a significant advantage in their industry. Sandisk Corporation trades at a higher price-to-book ratio of 9.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the given data. On the growth side, several factors contribute to an increase in revenue. Firstly, the data center and edge revenues have shown significant growth, with data center revenue increasing by $190 million over 6 months, and edge revenue rising by $968 million during the same period. Additionally, the supply agreement with Western Digital Technologies, Inc., has added a substantial amount of revenue, totaling $138 million in 3 months and $277 million in 6 months. Furthermore, Uni's venture has contributed 2% to condensed consolidated revenue over 3 months and 1% over 6 months. Lastly, reimbursement from the Employee Matters Agreement has also positively impacted revenue by $22 million. On the other hand, several factors have led to a decline in revenue. The reduction in utilization of manufacturing capacity due to flash market conditions has resulted in costs associated with this decrease, totaling $11 million. Moreover, a decrease in average selling prices, ASP, per gigabyte has partially offset growth in data center revenue. Effective management of cash conversions cycle and timing of payments for taxes and vendor relationships have also played a crucial role in revenue growth or decline. Changes in operating assets and liabilities have contributed to an increase in revenue by $313 million. Overall, these factors demonstrate the complex interplay between various drivers that influence revenue growth or decline. The net income of the company experienced a significant increase between 2024 and 2026. In Q2, it rose from $104 million to $803 million, representing a staggering 676% growth. This trend continued in the first half of the year, with net income increasing by 190% from $315 million to $915 million. The profit margins also witnessed substantial improvements, with the net income margin rising by 391% from 5.4% to 26.6%. The gross profit margin and operating income margin saw notable increases as well. In Q2 2024 compared to Q2 2026, the gross profit margin rose by 58%, while the operating income margin increased by 242%. The first half of the year also showed significant improvements in these areas, with the gross profit margin increasing by 67% and the operating income margin rising by 155%. These substantial increases in net income and profit margins indicate a marked improvement in the company's financial performance between 2024 and 2026. The company's financial performance has shown significant improvement in terms of generating positive operating cash flow. A comparison of the net cash provided by operating activities reveals a substantial increase from -$36 million in 2024 to $1,507 million in 2026. This upward trend is further supported by the 6 months ended January 2, 2026, where the company generated $1,507 million in net cash provided by operating activities. These figures indicate that the company has successfully transitioned into a positive operating cash flow position, which is a significant milestone for any business. Management's outlook for the company is one of cautious optimism. They anticipate a modest reduction in annual operating expenses, which suggests a focus on cost control and efficiency. However, this will be offset by a small increase in cost of revenue due to the transition to a contract manufacturing model. This shift is expected to bring long-term benefits, but it also requires short-term investment. In terms of capital investments, management expects a significant increase in fiscal year 2026 to meet growing demand and technological needs. To support this growth, they plan to access capital markets if necessary, indicating a willingness to seek external funding to drive expansion. Additionally, the company will transition to newer nodes to meet product portfolio demands, which suggests a focus on staying ahead of the competition through innovation and adaptability. Overall, management's strategy appears to be centered around investing in growth opportunities while maintaining cost discipline. They are positioning the company for long-term success by making strategic investments in technology and manufacturing capabilities. Concerns have been raised regarding inventory buildup within a company. The issue is evident through various metrics, indicating an accumulation of stock over time. The financial impact of this buildup can be seen in the increase of inventories by $109 million. This significant rise suggests that the company has been holding onto more products than necessary, potentially leading to wasted resources and lost revenue opportunities. Furthermore, the days in inventory have increased from 121 days to 156 days, indicating a prolonged period for goods to remain in storage. This prolonged storage time can lead to additional costs such as warehousing fees, maintenance, and potential damage to products. The acknowledgement of inventory buildup on page 15 highlights the company's awareness of this issue. However, it remains unclear what steps are being taken to address this problem and prevent future accumulation of stock. That concludes the financial summary for Sandisk Corporation. Feel free to comment below, and I will be happy to answer them when possible.